and it is just money. At least we have our health, and that's the main thing. But if it happens again, then I won't be so kind.
No.
Well, on that point, are you still investing in cryptocurrency?
I am, yes.
Talia?
He didn't tell me that.
Do I need to give you to a moment?
No. It's nothing like I put my whole wages in. It's just spare change.
Why would you? What's spare change? We don't have spare change to be throwing around, so why would you even bother putting it? Like, it's just stupid. Are you putting more money in there, like from your wages now?
Hello, darkness, my old friend. I've come to talk with you again.
Alright guys, welcome back to Wolfpack Cryptos and MMGinvest. This morning I'm going to do a quick TA update. It's going to be charts. Mainly charts. Alright guys, it's going to be quick as well. Alright, so I'm still expecting a possible pullback on the markets here. On the S&P, Dow, all the equities. The interesting thing is, gold for some reason is rallying, which is, it's signaling that that they're expecting a pullback in equities. So I like to look at the Russell 2000. First of all, this is not financial advice. Consult your financial advisor. This is more of an educational channel on how to trade. Once this video is uploaded, it's pretty much obsolete. Do not invest anything you're not willing to lose or lose sleep over. And equities, cryptos, all of this, it's extremely volatile, extremely risky. Do not even trade if you don't know what you're doing. Alright, here's Russell 2000. So, let's go to a daily chart. Here's a daily chart. It looks just like the S&P and the Dow. Now we did have a cross, a negative cross to the downside with the MA cross on the daily for the Russell 2000. But the price seems to be holding up. It had that nice bounce yesterday for Monday and Tuesday. See this candle right here? This is a nice bullish candle. Look at that wick, that buying wick. What is that? It looks like a hammer almost, but it's not. It's whatchamacallit? I already forgot. Anyways, the oscillators, they're neutral, slight bullish, I guess, because of the RSI. Get reset. It's been oversold on the daily. So I'm not exactly sure if this is going to sell off or it's going to continue to rally. Now there's a lot of resistance above 1500 here. And this is, remember, the Russell 2000 index. And the Russell 2000, it's 2,000 companies. They're smaller companies. You're not just looking at the S&P 500, the 500 largest companies. You're looking at mid-sized businesses. And I think that's a better indicator for the economy. We could also look at the QQ. We could look at other indexes, but the Russell has been pretty good for me. A lot of people look at transports. I'm not going to look at that right now. Also, another reason why the price popped was the moving averages, and because of, you know, Jerome Powell's 60 minutes interview. I guess that could have helped push up the market a little bit. But he didn't say anything new or anything that people didn't expect, so I'm assuming that's already priced in. So the heat map in the background is telling me there was a little more upside. But there is a lot of resistance at 1570 all the way to 1600. So we'll see if the price could break through it. Now if the price could get above 1600 on the Russell 2000 here, then we're going to start heading higher up towards the all-time highs, which was up around 1750. And there is a big green Ishimoku cloud. And if we start seeing a ramp with the cloud, then it's definitely going to shoot the price higher. That's the daily chart though. Let's take a look at the 3-day chart. Now the 3-day chart, I still see the 100-day moving average falling. And it could, once it crosses the 200-day moving average, the price could fall back down. And that's just that. The heat map on the 3-day is still, I mean, after all this red, you're going to see some more downside. And the MACD on the 3-day chart, you see the 3-day chart's more negative. The 1-day chart's neutral, slight bullish, but the 3-day chart is telling me there's more downside to come on the Russell 2000. TM squeeze is also still in the overbought territory, so is the momentum indicator, and the RSI still has a long way to go to become oversold. So the 3-day charts tell me there's possibly a few more weeks of downside. Here's the weekly chart. We had a nice 9 sell signal on the weekly. In the private group for MMG Elite members, that's why I bought in those inverse ETFs. Now, I'm going to probably buy them back if as soon as this little dead cat bounce or rally sells off again, if it does. So I'll buy those back. And they rallied. It's just that I wasn't paying attention. I didn't take profits on them. I just held them and we broke even. Or well, I took small profits on the other ETF. Anyways, so after a 9 sell signal on the TD indicator, you'll get 1 to 4 candle pullback or worse. On the weekly, the RSI is still in overbought territory, so is the momentum indicator. And the MACD told me to get out as well. So on the weekly, I see more downside. And the weekly is more important than the daily. So the 3-day and the weekly are negative. I guess we could look at the monthly. Why not? The monthly... I would say it's neutral, slightly negative by looking at just the oscillators. If this candle this week, if we close this week by Friday, 4 p.m. U.S. Eastern Standard Time, if we close this week's candle below 1500, then it's very negative. Then we're definitely going to retest possibly 1370 on the Russell 2000. So the daily, you know, we might see another little upside today, maybe tomorrow, but I would not be surprised that it gets rejected at 1570 when the price gets up there, and then we see some more downside. And once the price falls through this green Ishimoku cloud, which is again 1500, and again at 1500 we have a moving average as well on the daily time frame, then we can see the price accelerate to the downside and take us all the way back to anywhere from 1300 to 1400. Then we would see a nice bounce. There's also a little bit of support at at 1440, 1450. So I'm looking to buy back those inverse ETFs. Let's take a look at gold real quick. And this is for a swing trade. Nothing, guys, I don't like day trading. If I day trade, I'm not even going to post it in the elite members because most people, they can't keep up with. You should start out, I believe, in my opinion, swing trading. Then you can start screwing around with day trading. But honestly, swing trading, in my opinion, that's why I do it. Less stressful. It's more accurate. And your emotions are more in check. Here's the weekly chart on gold. Now, the MACD was going to cross to the downside on gold on the weekly time frame. And that's why I put my arrow down here at 1270. But if the market sells off, then gold might stay above 1300 while the MACD crosses to the downside. Not just that, we can see these moving averages start curling up, and once the 200 and the 100-day moving average cross my blue equilibrium line here, then we're going to see the price starting to shoot up on gold. And I've talked about how this, well, it looks like crap, how this blue line hasn't crossed, or how the 200-day moving average hasn't crossed above the blue line since December of 2002. And the last time it did that, we went into this massive bull, multi-year bull market up until the end of 2011. So it's a do or die situation all around. Because if the markets could sell off, could start selling off again, right? And this turned out to just be a giant bull trap, then it's going to put gold into a massive bull cycle. And then the markets could start their bear market or recession. Now, can the markets go higher and go past all-time highs? Technically, yes, if the Fed really starts up the printing presses again. You know, Venezuela, its stock market did great in the first years of its hyperinflation. But that's in dollar terms and fiat terms. In real value, not so much, especially after taxes. I'll talk about that later. So right now, this week is extremely crucial. This week, next week, this month, we're gonna. It's really crucial to what we're looking at here. If we're gonna go into a bear market on equities and go into a bull market in metals. So a lot of people are starting to talk about the yield curve again and bonds. The short-term interest rate on the yield on short-term debt, like the monthly, the 3-monthly, and all that, it's ticking higher than the 5-year or the 3-year and the 5-year. So that's very interesting. Now, for the past the past 7 recessions were predicted by the yield curve inverting, and you can see over here the 1 month is at a 2.4% interest rate, and well, that's the spread. But the yield curve's all the way down by this red line. You see that? So every time the blue line, the yield, the interest rate, the yield curve, inverted, and the short-term debt went above the long-term debt. So the interest rate on short-term debt, when it goes higher than the long-term debt, it creates an inverted yield curve, and it never happens until prior to a recession. and it's like predicted many recessions prior, right? The last 7, something like that. So yeah, it says right here, predicted the last 7 recessions. So you can see, you know, once it goes below the red line here, and we get an inverted yield curve, which is 0, that's what the red line is, we get a recession, and look how close we are to the red line. We're not below it just yet. So, and not just that, when it goes below the red line, below 0, and it inverts, we still have a few months of upside and maybe in the stock market, and then it finally starts, we go into a recession. The gray areas right here are recessions, right? So, you know, Black Monday, 1987 crash, dot-com bubble right here, mortgage-backed security crisis, 2007, 2008, and 9. Okay, no, actually that's right here. Right here was, this was the dot-com bubble, and then we had a small one in the early 90s. That's when Japan imploded. So, you know, we're coming up. In 3 months, we're going to have the longest expansion in U.S. history as well. So, you know, in the bond market, bonds have to go up. And when bonds go up, the blue line here, which is the S&P 500, is going to go down. I wish this could we could see a longer historical chart. I'll make another historical chart that could show us decades. But you guys have to understand that since Paul Volcker in 1981, bonds have been falling, right? Well, yields have been falling. And yields have to go back up, and so do bonds. Oh, here we go. Historical 10-year Treasury yield versus S&P 500. So here's the S&P 500 is the black line. The blue line is the 10-year constant, the yield on the 10-year Treasury bond, right? So as you can see here, the yield is going down, down, down. The S&P is going up, up, up. Actually, not so much. This is you know, I'm gonna go more in depth about that later. It gets a little complicated, and I have to say it in ways so some of you guys could understand. I don't want to use like jargon. Not just that, I'm kind of tired right now, and I'll just mess it up anyways. So yeah, I guess I could go live now. They've taken that away. I still have a strike, but I could go live for some reason, so I'm testing it out right now. I'll answer some of your questions now. So, Robert Kraft's buying jet fans massages. I haven't seen the news. Oh, Jim Cooper. I thought your name was Jim Cramer. Oh, the opening bell was like 10 minutes ago. And we're up 100 points on the Dow. See, I get carried away with these videos. I try to make 15-minute videos. Before you know it, it's 30 minutes. Alright guys, until next time.